Hello everybody, so today I'm going to be doing my first addition to my video series where I'm going to be kind of giving a guide on how to build out your discounted cash flow for the FA stock pitch competition. So my example I'll be doing on Delta Airlines, and today I'm going to be going over how to calculate your weighted average cost of capital. So I guess to get started out, one of the first things I would say that you should do is grab the 10Ks for your company through 2021 to 2025 and put those 5 years of historical data in Excel. Get the income statement, balance sheet, and statement of cash flows all in Excel. This is going to make the overall modeling much easier and the calculations a lot easier to find. And it's good to have all of the data in one place. So I would do this before you get started with calculating anything. It's just a little bit of grunt work to start out, but it's going to make the rest of the process a lot easier. So I guess to get started out with doing our weighted average cost of capital, you're going to want to make two tables like this. For right now, ignore this one on the right, and I'll explain this a little bit later on what this means and why we're going to use it. But to start, you're going to make a table that looks just like this. And this is how we're going to calculate our weighted average cost of capital. So to get started out, let's assume that you've already filled in the three financial statements. Let's start getting some of these values. So um, actually, before we do that, let's put in our assumptions. So for this case, we have multiple assumptions that we made. The first one is that our risk-free rate is going to be 4%. We also assumed an expected market return of 9.5%. And this is going to come into um, play for our equity risk premium calculation, as this is the expected market return minus our risk-free rate. So for that, we have 9.5% minus 4%. That's going to give us 5.5% for our equity risk premium. Also for tax rate, for this case, we're assuming a statutory tax rate of 25%. So you're going to make sure to notate that there. And then now we can get into starting getting our outputs that we'll use to calculate the weighted average cost of capital. So the first one, we have our short-term debt. And remember, for this case, for your total debt calculation, you're going to want to do short-term debt plus current portion of long-term debt plus long-term debt plus finance leases and then plus operating leases because they're all interest bearing. So for short-term debt, we're going to do an equal sum right here. And let's go over to the balance sheet. We're going to find current maturities of debt and finance leases for Delta. And remember, each 10K, each company is going to have them labeled a little bit differently in their balance sheet and different financial statements. If you need help finding this, just please reach out to me and I can help you out. So we're going to go ahead and take that figure, add it to our operating leases, the current maturities. Remember, not the whole. This is just short-term debt for right now. And then this might be hard to find at first. Some companies may have things like this. This fuel card obligation line, this is actually short-term debt. So we're going to include that in our calculation right there. And that'll be our short-term debt figure for Delta. And then we're going to do something very similar for our long-term debt calculation. This time we're going to go down to non-current liabilities. And here we're going to have debt and finance leases plus our non-current operating leases. And that'll be our long-term debt. Now we can calculate our total debt for Delta. One thing for equity, so this is something that confused me at first and could confuse people. For the weighted average cost of capital, we want to use the market value of the company's equity, not necessarily the stockholders' equity that we'll see on the balance sheet. So for the market value of equity, all we need to do, I'm just going to make a little note right here for simplicity. We need to find Delta's shares outstanding. So I'm doing all this data in millions. So Delta has 653.13 million shares outstanding and a current share price as of today of $66.76. And I'll leave this note for everybody because you'll want to notate this in your discounted cash flow on what day you got this data. So we can just do a little equation that times that, and that'll be our market value of our equity. Now we're going to come down. For now, I'm going to ignore this industry unlevered beta. We'll come back to this. Let's go to our debt to equity calculation and calculate debt to total capitalization and equity to total capitalization. For debt total capitalization, we're basically finding out just how much, what's the percentage of debt to Delta's total capitalization. So we're just going to come to here. Then what we're going to do is do total debt divided by total debt plus market value of equity. And then we're for the same thing for equity capitalization, so we're going to have equity as a numerator. So we're going to have market value of equity divided by total debt plus market value of equity, and then boom. And that's going to be a little ratio there. And then for debt to equity, this is just the ratio of debt divided by equity. So in this, we're just going to do total debt divided by market value of equity. That'll be our debt to equity. So now we need to come down to cost of equity calculation. And you're going to see one thing in here is levered beta as a component. The method we're going to be doing this is called the bottom-up method, where you're basically finding an industry unlevered beta and then you're going to relever it using Delta's financials. So over here I have 5 comps that I grabbed, and you're going to want to grab 5 or more comps whenever you do this for your company. Find companies with similar capital structure, similar industry, just comparable companies overall. And for these, we're going to want to find their levered beta, which we can grab by going to Yahoo Finance. For example, here's Southwest Airlines, and we can see the 5-year monthly beta of 1.18. So we just did that for 5 comparable companies, and now we want to calculate our unlevered beta. We want to unlever all of these companies' betas so we can find a median. So for this formula right here, is we're going to want to fill out the little table, 5 or more comps. You're going to want to use your levered beta, total debt, market value of equity, and then calculate debt to equity, similar to what we did over here for Delta's financials. So for unlevered beta, that formula is going to be, we're going to take our levered beta for our company. We are then going to divide this. I'm going to do a 1 extra parentheses right here. But we're going to do 1 plus 1 minus the tax rate. And for this, I will put a $sign right here to hold that stagnant. And it's going to be times our debt to equity for the company. Boom. And that is going to be our unlevered beta for United Airlines in this example. So there's the formula for reference. If you want to check out, if you're copying that, I'm going to leave that up there for a second. And then I'm going to flash fill this. Make sure you do the $sign if you're using like a cell to grab your tax rate to make sure it stays stagnant. But there is our unlevered beta. And then all we're going to do is come over here and we're going to use the median, and we're going to do that right there to find our median industry unlevered beta. Put it out to 2 decimals for that. So it actually comes out 0.72. That is our median industry unlevered beta. And now basically what we're going to do is relever this beta to Delta's financials to get our levered beta for our cost of equity calculation. So in this, what we're going to want to do is we're going to take our industry unlevered beta. We're going to multiply this by 1 plus 1 minus our tax rate times our debt to equity, which is for some reason in the, let me fix that before it was in the wrong cell. Perfect. So now we'll go back here, we'll grab our industry unlevered beta. We are going to multiply that by 1 minus the tax rate times that by our debt to equity. There is our levered beta. Now for our cost of equity, basically what we'll do here is it equals, we'll come our risk-free rate plus our levered beta times our equity risk premium. That is going to give us a cost of equity of 9.45%. And then for our cost of debt, what we're going to want to do is find our gross interest expense. So yeah, now we're going to go to our cost of debt. And there's a few things that we're really going to want to pay attention to here when calculating cost of debt. So I'm going to write this down right here. But we want to remember for total debt, we are including short-term debt plus current portion long-term debt plus long-term debt plus finance leases plus operating leases. And one of the main things you want to pay attention to here is with operating leases. So operating leases, um, their implied interest expense is not included in the interest expense line on the income statement. It's actually included in like lease expense. They factor it in there. So um, we're gonna find. I'm gonna show you how to kind of calculate that implied interest expense. For finance leases, this is actually netted into the interest expense line on the income statement, so it's already factored in. One thing you want to look out for is this interest expense net. You want to make sure that you check on that company's interest income before, because interest expense net means that it is interest expense net of interest income. In this scenario, I do not believe Delta made any interest income this year, so this is just the interest expense that they paid, or not necessarily paid, but the interest expense they accrued throughout the period for their debt plus finance leases, but we need to find this operating leases figure. So let me go over to balance sheet. So first to start out, I'm going to make a little side over here, and let's calculate our total operating leases. So we'll do equals plus non-current operating leases. And I'm going to pull up Delta's 10K right here. So right here I have pictured Delta's 10K form. And on page 77, we're at this section called lease position, lease asset and liability balance sheet position by category. So what we want to do is right here, weighted average discount rate for 2025 operating leases is 4.21%. We're going to want to remember that 4.21%, and then we're going to go to this times 4.21 would be 0.0421. That is going to be our implied operating lease interest. So whenever we go here, our cost of debt is going to be our total interest expense divided by total debt. So let's go ahead and calculate that. So we're doing our cost of debt percentage. So, okay, so now when we're filling out the formula for our cost of debt, we have our total interest expense divided by total debt, and that's including our operating lease implied interest. So what we're going to want to do, there's going to be a slight discrepancy here. As you see, interest expense is recorded on the income statement as a negative. Easiest way to combat around this, I found, I'll just move this right here. I know it's unorganized, but just, I guess, follow with me for the sake of simplicity. I'll do equals ABS. This is just absolute value. It's going to factor out the negative. We'll click on interest expense net. It's going to do that. We're going to do equals sum, and that'll be our total interest expense for the period. So what we'll just do here is we'll go to our weighted average cost of capital. We'll go to equals. We'll find our total interest expense that we've calculated, and then we'll divide that by our total debt figure. And that is going to give us a cost of debt percentage for our after-tax cost of debt. We're then just going to take that cost of debt that we calculated. We're going to want to multiply it by 1 minus our tax rate, and that is going to give us an after-tax cost of debt. Now we can come down to our weighted average cost of capital at the end here, and what this is just going to be is going to be our debt total capitalization times our cost of debt, or after-tax cost of debt, plus our equity to total capitalization times our cost of equity. And that is going to give us a weighted average cost of capital. And this is the discount rate we are going to use to discount future unlevered free cash flows to a present value to help us find an implied share price or intrinsic value of our company. So before we build our DCF, this is, what I would say is a good first step is calculating the weighted average cost of capital. If you have any questions or are confused on any parts of any of this calculation, um, feel free to reach out to me or other people in the group me to help you out. I'm happy to help with any group, or if you need help understanding any of these concepts, please reach out. And yes, again, before you calculate the weighted average cost of capital, I'd recommend the first step being get the income statement, get the balance sheet, and get the statement of cash flows all in Excel with 5 years of data. Especially when we come over to the DCF section, it's just going to make that part way easier. So, yep, thank you all for listening, and